Okay, fantastic. Thank you for your patience, everybody. I'm sorry we're a couple minutes late. We are happy that you are here for this fine session of the 2026 Summer Webinar Series. My name is Shelley McCallig. I'm the Director of Member Services here at CICU. It is my pleasure today to bring you the discussion designed specifically for higher education human resources professionals who are who are continually looking for meaningful ways to support employee well-being, enhance benefits offerings, and strengthen their institution's overall value proposition for faculty and staff. In today's webinar, our partners from the Voluntary Benefit Shop will provide an overview of the current long-term care landscape and introduce an innovative long-term care benefit that can be offered to employees at no additional cost to your college or university. The program is designed to provide greater access to coverage, portability into retirement, and benefits that again, support both formal and informal caregiving arrangements. We are also pleased to be joined by Natalie Rice, Head of Human Resources at Point Park University in Pittsburgh. Natalie's going to share her firsthand perspective on implementing the benefit earlier this year, including her institution's experience and the value it's brought their employees. That's about everything from me. We are recording. We will send you an email with a link to the recording and a copy of the slides, so you can sit back and relax and take it all in. If you have any questions, please feel free to pop them into the chat. And with that, I'm going to hand things over to Matt DiPasquale of the Voluntary Benefit Shop to get us started.
Thank you, Shelley. I appreciate it. And thank you, everybody, for your attendance today and your partnership in advance to hear about our organization, our partnership with CICU. And I have to give a special thanks to our guest speaker today, Natalie Rice, again from Point Park University. She's going to be here, Bill Spiro and Amy Eubank are also on here from our company. But Natalie Rice is going to be answering questions throughout this presentation, and then also be available to answer questions at the end. So she just went through an implementation for her institution somewhat recently, and she's been kind enough to come on and share her experience and field questions from some of you all, her peers, and talk through exactly what she felt about the process and the plan as well. So I'm Matt DiPasquale. I'm one of the three partners here at the Voluntary Benefit Shop. I'm also joined by Bill Spiro, our Director of Marketing and Sales, and Amy Eubank, one of our account managers and implementation managers. She's been working with the Coalition of College Cost Savings, NCICU, for years now. So you might recognize her name. We're happy to have her as a member of our team. And all we do is deliver this type of benefit that institutions and employers can offer their staff on a 100% voluntary basis that gives them long-term care protection to help folks, staff and faculty, protect their assets, their savings, and make sure that they can navigate a care situation themselves and or their loved ones if a care situation does come about. So there's no disruption to any benefit package that you may have or benefits you may have by introducing this plan. And we're, again, the endorsed broker for this plan for CICU, and also at the national level for the College of Cost Savings for the 30 states that we're working with or about that. Now, as I'm going along, please put questions in the chat. Bill will be able to navigate those and answer those as we're going along if you want to ask something during the conversation. But also, again, we're going to have time at the end to field any questions. So again, special thanks to Natalie Rice. We're very happy to have you on here, Natalie. Thank you. And just to see the results of what the implementation looked like recently for their institution, they had a total of 450 employees. 304 completed the process. And when I say completed the process, that means that they completed the process in saying yes or no during the enrollment and the implementation for this benefit. We had 71% of the population go through and say yes or no, which is fantastic. And 47 people decided to take a plan for themselves and or their loved ones. And Natalie, we're so grateful for your time and also this wonderful quote. You can see right here, the VB Shop led a highly successful rollout of the Standard and Life LTC program through the ACUP Coalition, and combined a smooth implementation process with clear employee-centered results. The rollout was thoughtfully executed, highly collaborative, and impactful for our employees. And I promise you, we did not pay her to say that. They were very kind words. And we couldn't wait to actually put that on our website as well. So thank you again, Natalie. Bill, is there any questions in the chat before I get going?
Nope, there are not.
Okay. Here's my wonderful headshot and contact information. Everybody's going to get, a recording of this and our contact info after. And here's Bill as well. And, we're going to start by talking about what really the point of this type of plan is. So we're going to take a step back and talk about things that might seem like common sense, but I think it's good to put things in perspective. There's, four phases of life. There's childhood where we're being taken care of. I have a 5-year-old. I missed those days where I was the one being taken care of. There's young adulthood where you're preparing for independence, adulthood where you're building your nest egg, and then there's retirement where you're utilizing and protecting what you've built up. And that's what we're going to talk about today. Okay. Long-term care can protect people, at really any time in their lives if something could happen, but most people will use this in their retirement years. Okay. But so protecting assets, retirement funds, and making sure that they're not depleted when a long-term care situation does take place. So here are the four biggest risks to retirement assets. And this is what we work our entire lives for, really. It's being able to retire, enjoy it, pass on assets and savings to loved ones so they can then enjoy it as well. So the four factors here are inflation. We've all seen in the past, 8 years or so, inflation, unlike a lot of us have ever seen in our entire lives. And the cost of living increases at an average of 3%, they say. And the amount of money you need to buy the same goods and services will double in 20 years. So that's just a factor of life. There's the longevity risk, okay? Running out of money, running out of assets, we're all living longer all the time. And then there's the sequence of returns risk. If your portfolio drops, okay, you're forced to sell off more assets to cover your living expenses. So therefore, you're depleting something that maybe you were hoping would continue to build. So it depletes your capital early on. And then there is the healthcare and long-term care costs. And in my opinion, this is probably the biggest risk out there. Mm-hmm. So Medicare does not cover everything. Okay, Medicare can, but Medicare only kicks in, when at certain times, and it might not be what everybody is trying to resort to. So these types of plans are going to help people get ahead of the potential risks of long-term care costs once people are usually not even working anymore. So now the income may not be coming in at all, or it's coming in at a much lesser, to a much lesser degree. And people, focus on accumulating wealth, accumulating savings. They don't always take that next step and think about protecting those things against the potential of those long-term care risks. Okay. Now, Billy, I'm going to pass it to you here to take over on this slide.
Sure. Well, thank you for that, Matt. And so everybody, life with long-term care, this benefit that we're talking about today, is the fastest growing voluntary benefit and fastest growing executive level benefit. And it's really the result of 5 pretty big explosive factors. Like Matt just said, people are living longer than ever before. That's a good thing. But as more and more people are going into those, golden years and extended years, more people are needing care. So it's just basic economics. When there's more people needing something and really less access to it, the costs are going to go up. So rising long-term care costs are happening now. Some state governments, some politicians are starting to get involved, having conversations about creating more awareness for long-term care, talking about programs that they could get to sort of guide people into long-term care benefits and private policies. It's not a very big market out there. There's not a lot out there for long-term care on the open market, and it's shrinking. So, all of that have really added up to the evolution and explosion of this combination life with long-term care plan. These are some really, I think, interesting numbers from the last couple of years. The first one, 22%, and this just speaks to the popularity of this plan and how it's being so well received and why people are choosing to participate in this benefit. Over the last couple of years, there's been a 22% increase in new premium for individual life combination products. That doesn't mean that people's premiums are going up. That just means that many more people have chosen to protect themselves with this benefit. 36% of employees have expressed that they wish their employers had a long-term long-term care benefit option in place for them. What I want you to take a look at on that column, look at the Gen Zs and the millennials, 31 and 38%. They're just as interested as the Gen X and the boomers. And, we get feedback from groups after rollouts, and we talk to the Gen Zs and millennials, and, why are you all, they're way more benefits conscious than I was. I always tell people I'm part of the bulletproof generation. But this, with the Gen Zs and the millennials, what we're hearing a lot is, I'm dealing with my family's dealing with a long-term care situation with a parent or a grandparent, and they're actually part of family caregiver teams because that loved one doesn't have a benefit, and they're requiring that family to provide the majority of the care. And what they're saying is, I don't want that to be me. I want to have something in place so my family's not changing me and bathing me. And, I want to have options at professional care. So I think they're looking at it really, really responsibly. And it just speaks well to that the people in those ages are choosing to participate in this benefit at a pretty high level. 29% of companies have said they're interested in or intend to offer a long-term care benefit in the future. More than half of employees have said they wish their companies or they would be interested in purchasing a long-term care benefit if their companies offered it as a voluntary benefit.
So, Natalie, I'm gonna, ask you a couple questions here because I'm sure those in attendance probably rather hear from you more than from us. So, what was there a demand from the faculty that you were aware of before that? Before we spoke, did anybody come to you, or did you do anything like a survey or questionnaire?
So yes, we actually we do surveys occasionally with our faculty and our staff, and we do ask these particular questions. Is there something that we're missing? And we did have long-term care benefit way back when, but that changed over time. And one of the things we've had a lot of individuals who were in what you're talking about had to care for their family members. I'm one of those individuals, and I thought to myself, what I've had to do for the past 10 years, I don't want that to have to be, I don't want to have my children do that for me. I want them to be able to visit me and do all of those wonderful things, but I want to make sure that we're covered. So one of the things we always did are surveys, and it kept coming up like, do we have a long-term care benefit? When we bring new people in, do you offer a long-term care? Do you offer this? Do you offer this? And we did notice it as well. When you see this 36%, that's exactly what we noticed as well. It wasn't just the Gen X or the boomers saying, we should really have this. It was our Gen Z or millennials saying, hey, we think this is a needed benefit. And then through the offering, we were like, well, this is a great benefit because it's even, in my opinion, more. It's a wonderful, wonderful benefit. And when you are an individual who's going through that, and you can see like what this offers is it's just phenomenal, in my opinion. And the fact that our the people who've even taken it, our 47 individuals, they would spread over this 36% very well. It's all over the board. So yes, we do surveys. We've been asked for it many times, and we're very glad through this coalition we could do so.
That's great feedback. Do you usually do your surveys during your core enrollment, or do you try to do it before then so you can implement anything during the core? Typically?
So we do our surveys way prior to our open enrollment. And what we liked about this particular benefit was it was outside of our open enrollment period time, which was very important in our opinion, because you need to focus and you need to completely understand. And when you're provided with changes in your medical and your dental insurance, this isn't something that should be alongside it. It should stand alone so that you fully understand what this benefit's about, how it affects the future, how it ties into retirement and life insurance and all of these wonderful things. And I can talk more, and I'm sure we will later, about the whole process, but that is one thing that was a definite advantage, was not having it coincide and definitely being a separate benefit offering at a different time.
Yeah, we will touch on that more, but I think that's a great point. I mean, not only does the staff and faculty have a ton going on, you all have a ton going on during core enrollment, right? Mm-hmm. So it is a lot to add an extra thing when you already have so many decisions and so many balls to juggle. So Billy, I'll turn it back over to you. Thank you, Natalie.
Sure. Yep. And again, folks, we'll move through this pretty quickly here. I know we want to be respectful of your time. I think we all know what long-term care is, right? That the important thing to take off this slide is, with the benefit that we manage, People have the ability to stay in their own home. If they don't need that round the clock 24/7 monitoring, they can stay in their home, their family being the primary caregivers, with a professional coming in as frequently or infrequently as needed. A lot of those standalone plans that have been out there for a while required that people go into a facility to get the benefit. With this plan and staying in your own home keeps people comfortable, keeps them surrounded by the people they're familiar with, and also, and really almost even as, if not more importantly, helps them protect those savings and assets longer. The finances of having someone being cared for in the home against in a facility, and we'll show you a slide on what cost of care looks like, is significant. And a big part of what long-term care does is it helps families protect those savings and assets they've worked so hard for and they've sacrificed into a 401k. You don't want that just to disappear into a long-term care situation in a very quick amount of time. So you'll hear Matt and I talk about protecting savings and assets a lot through this, because it's really one of the most important things to consider when you're considering this benefit.
And also remember, long-term care doesn't, it will cover this benefit will cover in your own home, but it obviously will cover the nursing home, the assisted living facility.
Yep.
But it's not just end of life care. Okay, it also could be someone having that early car accident, stroke, heart attack. We do see that statistically. It is more in later years, but not solely for that.
Yep, they are projecting that 70% of the people over 65 are going to need some type of long-term care. 20% of those are going to be those cognitive impairment, those Alzheimer's type dementia, things that we know can drag on longer than a normal long-term care situation. This slide shows you what a nationwide average for a year cost of care looks like. You're in New York. I don't need to explain to you that it's probably one of the more expensive areas in the country. This factors in everywhere. A year being cared for at home, on average, is just over 80,000. A year in a nursing home is just under 115,000. A private room in a nursing home is just under 130,000. If someone has one of those cognitive impairment, Alzheimer's, dementia situations, and it goes on for a little bit, the cost for the final 5 years of life for those people on average is 367,000. The average lifetime cost per person needing care is 172,000. As you can see, these are some pretty big numbers. And there's a lot of people that don't just, again, their finances would disappear quickly if they had to cover that cost on their own without the support of a benefit. There's not a lot out there. It's a pretty small market at this point in time. 20 some years ago, turn of the century, there were more than 100 companies and carriers selling standalone long-term care. Now it's fewer than 10, and there are no carriers selling group-based standalone long-term care policies. Last company doing that was a carrier called Unum. They stopped that as of February 1st. So these hybrid plans are really dominating the market. And we feel in a lot of ways they're with a lot of the flexibility to them, they're stronger than the standalone plans. Something else to consider. Anybody on this call today could reach out to a financial planner or a long-term care specialist and say, hey, I want to start down the path of getting a plan. Be ready for very challenging underwritings. It may be the toughest benefit to qualify for with underwriting. And many, many times, the people who are the most vulnerable and those who are going to need to stand the biggest chance of needing the care, they get declined. So, this is really about access is another really big important thing to consider. Our benefit that we manage is going to be guaranteed issue, and it's going to give a lot of people at your universities the ability to get a benefit that they stand no chance of getting on their own because they can't get through the underwriting. So it's another thing to really, really important to consider.
So Natalie, you said this earlier, but Point Park is actually one of the groups, a real life example of what the Bill just talked about at the top here. You guys had a group standalone plan. I forget, was it with Genworth or John Hancock?
It was with Genworth, yeah.
With Genworth.
Mhm.
And then they stopped allowing you to add people to it, right?
Correct.
Yep. How long ago was that?
Quite some time ago, probably 10 plus years.
Okay.
That we could not do that any longer. So, and then there was just, it felt like that there was just a gap, right?
Right, exactly. And know that if anybody else on the call had an old standalone policy or still has an old standalone policy, we don't come in trying to suggest that you should replace this with that. This is a path forward. Those plans just can't add anyone new. So we wouldn't say that anybody should get rid of those policies, unless they become cost prohibitive at some point because the carrier keeps increasing the price. It's best to keep those, but this is the only way an employer can offer a long-term care, retirement, savings, asset protection plan with no medical questions to their staff at this point. Okay, I think that was it for there. So when we get in Billy, I can't remember if this was me or you. So you.
I think this is you. I think I'm back on section 3.
Okay. So this part is talking about the lack of proper education leads to misconceptions. And what I would say is that these types of benefits are new to most folks, but really the main thing we have to educate them on more so than the plan are the misunderstanding that they think that they're already protected with things that are in place, right? Mainly, you can see here, a lot of employees think that health insurance and the Affordable Care Act are going to help them with long-term care. Everyone needs health insurance, and the ACA Act has helped a ton of people, but they don't have with long-term care. Medicare only kicks in for the first 100 days, and it depends on the type of care that it is. So that's not really long-term care because that doesn't kick in until day 90 for long-term. Medicaid can help with long-term care, but that means that your assets and your savings, again, have been depleted. And when I say depleted, it's significant. I'm going to show you a real life example here in a second, and that might not be ideal for everybody. Medicaid can also take away some of your choices. Okay. It can be the choice of from a geographical standpoint where your care can be provided because it needs to be a Medicaid approved facility or care plan. It also can be the quality of that care. So again, these plans give you the autonomy and the flexibility to choose your care path, not be subjected to whatever the Medicaid system will allow. And here are the most jarring stats when it comes to this. Your Nationwide Retirement Institute found that 58% of surveyed U.S. adults wrongly believe that Medicare, covers long-term care. And then Kaiser Family Foundation revealed that 45% of adults over the age of 65 assumed that Medicare would foot the bill for a nursing home. So again, this is a very misunderstood aspect of our medical system. And it's because it's confusing, right? It's confusing even for people that are in the insurance realm. And, I'll pause there before I go through the example. Natalie, did you find that, or did you get any feedback that people learned something from the education in regard to what we just talked about on those 2 slides about these misconceptions? Did you get any feedback that our education campaign helped with that?
I definitely did get some very positive feedback regarding that because people were under the impression that, well, once I go off of my, employer sponsored plan, no problem, it'll all be covered. And then you see information like this, or you begin to, they're like, well, what do you mean it's not going to be covered? Well, 100 days, what's that? Well, I don't understand. And so really being able to bring this to them to say, do you get this? And then people who are on the other side and working even with Medicaid, that's even worse because you would know that you have to exhaust everything. People don't realize that. They're like, well, can I keep my house? Nope.
Right.
You can't. And you won't be able to. And so the education that went along with this was huge. And it helped not only for people to understand this, but it also helped people to start to think about, well, what does Medicare offer me? Not only here, but I need to even know a little bit more about it. And I thought that was definitely beneficial. And one thing I just wanted to add too was when you were talking about the guarantee issue, that was huge for people going ahead and taking this. Because when we issued it out, people did say to us, I don't even know why you're sending this. I'm never going to be able to get it. And it's like, did you read that it said guarantee issue? Oh, that doesn't apply to me. Yes, it does apply to you. And so that was really important. They always thought, well, it's not going to apply to me. I tried this before. It's not going to work. Well, now is your option. And
Right.
the education was huge around both of those aspects.
That's great. All right, so here's a real life example of a spend down, and when we go over this with employees, their eyes get really big. So here's the situation: it's a middle class married couple, John and Mary, near Havre de Grace, Maryland. That's where our headquarters is. They have a combined net worth of 650,000, 350 in paid off home, 200,000 in 401k, and 100,000 in liquid savings. And their modest retirement income from Social Security covers their standard living expenses, but they have no long term care insurance. And then the event happens. John has a stroke. He needs in-home assistance, and he needs to transition into a specialized memory care or skilled nursing facility. We all know someone that's gone through this. So here's the financial toll. Okay. In the Maryland area where we live, and I'm sure, it might be a little bit higher in New York, I assume, depending on where you are. The nursing home care average is about 115,000 to 130. And if he requires 3 years, okay, that's roughly, $360,000. And then the spend down happens because Medicare only covers the first 100 days of skilled nursing rehab, John and Mary must pay out of pocket, and they have to liquidate their savings, 100,000 of it, and cash out 260,000 of their 401k to pay the facility. And then there's the tax hit. Okay, the cashing out that 401k creates a massive unplanned taxable income, and it pushes them into a higher tax bracket and accelerates the depletion of their pool of assets. And then here's the outcome. Okay, John eventually qualifies for Medicaid to cover his ongoing care, but only after he had liquidated nearly all of their liquid wealth. And Mary's left to survive on her retirement funds, her Social Security. The home is shielded because from immediate sale by Medicaid because of the spousal impoverishment rules. Okay, if it was somebody that was single and they left their house, then the home could even be seized as an asset in that situation. But then it becomes subject to Medicaid estate recovery upon her passing. So rather than it being able to be passed on to loved ones, okay, then not just the home, but also the savings and the retirement has no longer been able to pass on to their loved ones. So this is a real life example. Okay, Medicaid is not the ideal situation for everybody. Unfortunately, it's where a lot of people land. Now, again, the reason to offer this is to preserve your assets, make sure you're not having to liquidate your 401k or other assets, reduce your family burden. You don't want to be a burden on loved ones. Natalie talked about this earlier, and give you your freedom of choice of care geographically and the quality of care. We already talked about some of these stats, but just to recap a few, 70% of Americans, if they make it to 65, will need long-term care. About a third of employers are offering this, and we are talking to new institutions and universities all the time. This has become a very popular plan in your type of industry, and it's a good way to stay ahead of what your peers are doing, or stay in line with what your peers are offering. Now, fewer than 1 in 30 Americans own a long-term care insurance plan. Only 7% of adults over 50 have a policy. So think about that gap between that stat I just said and 70% of Americans over 65 needing it. That's why so many people are going into the Medicaid system. People aren't addressing this. It's because they don't know. It's just because they're not educated on it. And we even see people get excited about this plan at the executive level. And it's hard to get executives excited about it, anything from a benefit perspective. And I think it's because it speaks their language about protecting assets, protecting retirements, protecting savings, passing it on to loved ones, rather than it, being consumed by the state or long-term care bills. Now I'm going to talk about legislation quickly, just because it's something that we need to make sure that you're aware of, being in a state that's considering this. This is not the reason to offer the plan, though. Okay, this is a symptom of what a issue and mess long-term care is in our country. Again, it's not the reason to offer the plan. What you see here is a heat map of where on a state-by-state basis, what states are spending the most percentage of their Medicaid budget towards long-term care. The stat I want to direct your attention to is the second bullet point on the right. Nationally, the $164 billion Medicaid budget, 31% of it, about a third, is going to long-term care. This is not sustainable. Okay, you can see New York's at 18%. Medicaid is going to be crushed by the weight of long-term care if people don't do something. So that's why politicians have now started to get involved with this, and know that we don't talk to at the employee presentation level. We don't talk about this, but as an administrator, you need to know, because you would have to administrate any tax that would be passed. So Washington State's the only state in blue that's passed an actual bill to start a payroll tax with long-term care implications. New York is a state that actually has drafted a bill that is following Washington State somewhat closely. And here's the high-level overview. In 2021, Washington State gave all the employees in their state a 2-year runway to get their own long-term care plan, whether it be a hybrid life with long-term care plan like the ones we're talking about today, or an individual plan. But if they didn't have one, they were going to be inserted into a payroll tax for the rest of their working career. Okay, this isn't like an annual open enrollment. It was a one-time shot. You either got your own plan or you did not. If you did not have your own plan, you got subjected to a 0.58% payroll tax for the rest of your working career, whether you make $500,000 or $50,000, and all that benefit could get you once you were vested was a lifetime maximum of $36,500 or $100 a day. It's a drop in the bucket from what we just went over. So, as other states look to possibly implement this type of tax plan, you need to follow suit with what happened in Washington State to give relief to the Medicaid system. You will get a clamoring from staff if our type of plans would allow for a tax opt out because they could take control of that money, get a better policy, more protection, a death benefit as well, so on and so forth. Don't offer it because of this, but it's something that you would already be getting ahead of. And again, just so you know, in case people see it in the news, you can speak knowledgeably to what may be happening. In New York, there was a bill introduced all the way back in 2022, but as of right now, they redrafted it. They introduced another one in January of 2025, and nothing has actually been put up to a vote yet. I don't think anything will happen this year, but it's having the desired effect in Washington State. It's forcing people to educate themselves and take action. So I think it's something that will continue to gain traction over some time. All right, Billy, back to
Okay,
you.
everybody. Yep. So again, and now we're going to start to get into how this works. So what is a life with long-term care, the hybrid program? It's simply just one benefit that combines long-term care and life insurance into one plan. I think we all know what life insurance does. Long-term care is there to provide benefits in the event that the policyholder can't care for themselves. And like we've talked about a few times, because it's important, the benefits are designed to protect the families and savings and assets and provide freedom of choice with the care options. With this benefit during long-term care, tax-free, basically cash payouts are going to be going out to that family, regardless of who and where the care is being provided, and can be spent on anything that family needs to best navigate that situation. If they got the person home, they want to use the money to pay a mortgage to keep the house afloat, it's going to be their decision on things like that. Why these plans are so appealing and being so well received. Bullet point number one on the left is 100% of the policyholders in those families are going to get a benefit either from the life insurance, from the long-term care, or a combination of those two things. Natalie really spoke well to the importance of guaranteed issue. We don't need to keep beating that up. Stable premiums. Once someone gets a benefit, they are locked in at that premium for the rest of their life. So if someone enrolls and they're 40 years old, they work another 30 years at your college or university, they go into retirement, that premium is going to be the same. The plans are 100% portable. Faculty and staff can take this with them into retirement. And the premium of the day that their plan went live, that's the age premium they're going to pay for the rest of their life. With the standalone plans that are out there, again, I've talked with people whose premiums have gone up five times, 500%. With this plan, again, you are locked in at that premium and those benefits for the rest of your life. Your premium will never go up. Your benefits will never reduce. Indemnity products simply means it's going to pay the same percentage and same amount out every single month. Families can budget for it. They're going to get the same amount regardless of how much or how little they're out of pocket for care that month. With the standalone plans, again, as a comparison, those tend to be reimbursement plans. Those are plans where families have to jump through the hoops of taking receipts to the carrier and how much can we get this month. That's not how this plan works. We're a few slides away from showing you exactly how that does. We talked about the importance of informal care and being able to stay at home. These plans have interest rates attached to them, and they are building cash value every month. And after a couple of years, then you build up the cash value in your plan. If someone gets in an emergency and they need money, they can borrow against that cash value in their plan. If someone ever has to surrender their plan, and we see that next to never, like the persistency rate on these plans is really, really high. But say someone had to, they had to do it. They could then surrender their plan and get their cash value out. So what cash value does, it works in two ways in helping families create a financial asset that they can use in one of those two ways if they ever need to. Again, it's fully portable. It should be because it's meant to help protect people later in life. So once people get the plan, they own it. At the beginning, you all are just acting as sort of the vehicle for doing the after-tax deduction, paying the carrier once a month. If they leave your school, they can take it with them and set up direct billing with the carrier. This is pretty self-explanatory. I won't spend a ton of time on this. Why this benefit is important at certain ages. 50 plus, you kind of know. People are getting towards retirement. They really should have that box checked on their benefits portfolio by the time they're 50 or shortly after about getting long-term care. Goes back to that 70% number. Guaranteed issue is going to be really important here because people, when you get to this age, your chances of having some type of pre-existing condition, are higher than when you're younger. Ages 40 to 49, again, they've got an eye towards retirement. If they get the benefit in this window, their premium is going to be lower. Every age has its own premium. It's not banded. Every single age has its own separate premium. The younger you are when you enroll, the lower your premium is going to be. The younger you are when you enroll, the more cash value you're going to build up, which can be accessed in the case of emergency. People in their 40s are still adding to their life insurance portfolio, and this is something to strengthen that as well. And again, the guaranteed issue is important at any age because life can happen to anyone at any age, but kind of the chances go up the older that you get. Back to the Gen Zs and the millennials, 20 to 39, they're locking in at the lowest premium they'll ever be able to get for their life because again, it stays that for the rest of their life. People in this age window are getting married, starting families, so they need to provide security for those new family members. And sorry about that. And this checks that box. This gives them a permanent life insurance plan that they can access. If they never need long-term care, it's going to serve as life insurance. And again, the younger you are when you enroll, the more cash value that you can build up and access if you ever need that down the road.
This pie graph on the bottom left-hand side here shows the real statistics from our entire block of business, and you can see that half the people that enroll are under the age of 40, which is always surprising to folks when they see that. Most people think it'll be people closer to retirement age.
Yep. So this is how the plan works. And it comes with all three of these things built into it. People don't check boxes. This is all factored right into the premium. It starts off as that permanent life insurance plan. If someone never needs long-term care, it's going to pay them that death benefit, just like life insurance we're all used to. If a doctor diagnoses that someone's terminally ill, which sadly just means they're not expected to live 12 months longer, at that point, that person and their family can take up to 75% of the policy's face value as an advance. Again, the money comes out tax-free. It's an after-tax deduction. There's no tax liability on whoever's receiving that if it's a beneficiary. Whatever they don't take as an advance gets paid out when that person passes away as a death benefit. Where long-term care comes in is this. A long-term care diagnosis is very simple. A doctor says someone can't do 2 of these 6 activities of daily living in the boxes along the bottom on their own, or they have severe cognitive impairment like Alzheimer's or dementia. That's a long-term care diagnosis, and we'll move one slide. We can work off a $100,000 policy example as we show you how it pays out. Once that diagnosis is made, there has to be a 90-day elimination period where care is being provided to that individual. Industry standard, all the carriers have that. Once that window is satisfied, the benefit will start to release, the policy will start to release 4% of the face value a month for up to 25 months. So if you have a $100,000 plan, you'll get $4,000 every single month. If you have a $200,000 plan, you'll get $8,000 every month. That's an indemnity payment. So they're going to get that regardless of how much or how little they're out of pocket that month. So they can budget for this. They know what's coming. They can map out what they're going to use it for. While these payouts are being made to a family, no premium payments are due. So no one has to scramble to make a premium payment while that family's in this situation. Now, if you have a $100,000 plan, you have $100,000 to use one way or the other. Life insurance, long-term care, a combination of the two. Say someone gets 10 payouts, $40,000, and they pass away. The other 60 would be paid as a death benefit and life insurance to that family. So it's pretty easy.
So this isn't better than term life insurance. It's different, right? This is covering the blind spot that's long-term care. Natalie, Point Park already had a group term plan, employer paid and voluntary as well, or just
Correct. Employer paid and supplemental. Mm-hmm.
Right. So, know that a lot of people at first will say, oh, it's another life plan. Well, it's life in name, but it's covering the long-term care aspect of it. So this isn't replacing any benefit that you would already have at the institution.
Yep. I think I'll say, and I'll say this a lot in presentations. We've never heard anybody walk away from a rollout saying, "Oh, I got this great life insurance plan and it's got some long-term care built into it." No, people are focusing solely on the long-term care. The fact that it has that death benefit just makes it a more valuable benefit and guarantees that every family is going to get something from this policy. This is a underwriting offer, which you all can expect. We're going to be able to get, no matter what size your school is, a minimum $200,000 in guaranteed issue. So anyone's going to be able to get up to that amount without having to answer any questions on an application. Spouse guaranteed issue will kind of go up and down with a carrier. Once an individual gets a plan, they can get a plan for spouse, children, dependent grandchildren. If someone wants to go above the guaranteed issue amount and try to get more coverage, they're going to have to answer a couple underwriting questions. If they get declined for one of those, they're not denied the whole policy. They're simply taken back down to that guaranteed issue amount, and they can get anywhere from that $200,000 down below. And with the carriers that we work with in New York, people are going to be able to obtain this plan up to the age of 70. So, I know most schools have faculty and staff that are above 70. Unfortunately, those people, aren't going to be able to get this with the long-term care built into it. If they ever ask us about it, we'll explain to them that they can get it as life insurance and only have a couple underwriting questions, but we don't see that happen a lot. Something that we have with a couple carriers is this is really strong, and it's called perpetual guaranteed issue buy-up. And what it means is anybody who gets a policy at their first chance to say yes. So if you move forward with this, your existing faculty and staff will have their one chance at guaranteed issue. We do a once a year new hire onboarding open enrollment. We'll talk about that a little bit more. All of those new hires get their chance once that first year at guaranteed issue. Anybody who gets a plan, and they can even get the smallest plan available, $10,000. If they get that small plan or any size plan, they have the rest of their time employed at your school at any future open enrollment to go back and get more coverage up to that $200,000 mark without any underwriting. We have a couple carriers that offer this, and one will be available to you all in New York. And this is just a really powerful buy-up feature. Just think about it this way. I want to get a $10,000 plan to get my foot in the door. The premium will be next to nothing. That's just guaranteeing me that if I ever get bad news at a doctor or something happens and I realize my chance of needing care just went up, I then have the ability to go back and get more, and I don't have to answer any questions about why I'm getting more. And if you're familiar with how tough long-term care underwriting is, there's nothing more powerful than that buy-up feature. Since we got this about 18 months to 2 years ago from two carriers, we're seeing more and more people just get that when it's properly explained to them, which we do, get a small plan just to say, hey, I'll go back if I ever feel like I need more. Now I can go back and get it regardless of what my health situation is. Someone gets a $20,000 plan. 5 years later, they want to get another 100. That 100 would be a second policy at a different premium because they're going to be 5 years older. Those two plans would stack on top of each other, pay out together, but it would be two separate premiums, that would total up to what's coming out of their paycheck.
Natalie, do you feel like this feature helped encourage participation?
Oh, it definitely helped encourage participation because again, it's that guarantee issue. And like you just said, going back to that if you can get your foot in the door, I know many people that did that. They said, I'm going to get my foot in the door with a smaller policy and then build my way up.
Yep.
And that's something that's really, really important. Again, you may not even get the bad news or something that might happen. You just might want to say, maybe I get an increase, or maybe as my trajectory changes in my job, I get something else. I have now a little bit more that I can spend towards my future and being able to save, which is one way in which you can do that. And it's a great added benefit.
Yeah, I feel like this is one of the features and one of the aspects of our model that really helps with participation at every level, but also a lot for the younger folks too, because there are people that might not be considering, really worried about long-term care yet, but they're like, I never know what's going to happen, right? So it engages them, and then they're paying more attention because of this aspect. We're one of only a handful of brokers in the country that has this type of underwriting. So this is a big advantage of being able to get this through CICU and through the College of Cost Savings, the Coalition of College Cost Savings. All right, so now we're going to talk about how we actually implement this a little bit. So, Natalie spoke about this in the beginning, but we're always handling this enrollment off cycle from the core. There's so much going on. You have a lot going on. The staff and faculty are already making so many decisions. They're overwhelmed and they don't know what their budget's going to be year over year to have another benefit coming at them that they've never heard of before. Everybody knows basically, to some extent, dental, vision, medical, term life insurance. People have heard those before. They haven't heard about this. And those other, core benefits, obviously they're very important, but people can make changes to them quite frequently, year over year, life changes. With the life with long-term care plan, it's usually something that they're planning to keep until they need it, right? Until they pass, until they go into care. So keeping it off cycle where they can digest the information, learn about a new benefit, think about something that's typically, going to be a long-term commitment is something that's very important. Also, another reason why we do this off cycle from the core is because Bill alluded to the way the rate structure works. Every age has its own unique rate. This plan doesn't work on bed admin systems. So it's a nightmare for you all to have to try to, fit a square peg in a round hole. So for that reason, we provide an enrollment platform called Solarix at absolutely no cost. And it allows for the rates to work. Medical questions are built right into it. You don't have to administer it throughout the year. And we only conduct enrollment once per year. So new hires get guaranteed issue at that annual enrollment moving forward, and you're not having to worry about adding one more thing to any onboarding that you have to do. So we're all about trying to make your life, we're trying to simplify your lives. So Natalie, how was, I know you already said that the off-cycle enrollment was something that, you were excited about. Did you come into it knowing that you'd rather be off-cycle, or was it after we talked to you about it that you were like, okay, that makes sense? Because a lot of times we hear people say, we only do benefits one time per year.
So it was actually afterwards, we had talked about it and we thought, no, we want to do benefits once a year. We don't want to have to revisit this and everything else. But then after the conversations happened, and then when you said the magic words of, hey, we have the enrollment platform. You don't have to put this in your Ben admin system. This isn't something you have to do. This is just like, oh. Okay, now you're talking our language like this. Okay, this is going to make sense. And then when you tie it all into the people's backgrounds and the whole Medicare and everything else, and making sure the people understood it 100% made sense that it was not tied into the core benefits.
Okay. And thank you for that. And then, just know when we do our implementation, it's in a very methodical, calculated way. Like you're not going to feel rushed at all. We do a kickoff call and then we do a slow build up. It's an 8-week implementation process. We're doing weekly touch point calls with you to show you where exactly we are, allowing you to have time to see and approve, everything that the staff and faculty would be seeing. And then we do a drip education campaign for 4 weeks before open enrollment. And think of it like modular learning. It's not redundant, repetitive information. And then we do enrollment for 2 to 3 weeks, and it's non-intrusive. Employees can literally self-enroll, self-waive, or they can speak to our in-house call center counselors, bring on a parent, bring on a spouse, a financial planner. So, it's not something where people are, forced to have a one-on-one conversation. Nobody's going on site. It's a very non-intrusive, process. And again, we take pride in making sure that people have the time and the information to educate themselves. And we appreciate how busy they are and how hard it can be for them to have access to the information during the course of the day. So they can get to it in the evening when they're at home over the weekend. And we'll really accommodate any needs that you might have. And the overall goal, we have participation requirements waived. We need a minimum of either 5 or 10 applications, depending on the carrier, but we don't have like that hard 10, 20, 30% participation, because the carriers know that we're going to educate folks, and the magic number is to get 70% of the population to say yes or say no. And that way the carrier knows adverse selection is not taking place, where it's just the people with pre-existing conditions coming to the meeting. So that's how we're able to get the best underwriting offers in the country without strict participation requirements. And also we're going to create every single sort of communication for you. We have all of these different things at our disposal: email, video content, text message for people that might not be, looking at emails or workstations, live and recorded webinars, that self-service platform, and the call center support. So Natalie, specific to Point Park's implementation, just give us some context on what you think that, what took place that made it so successful. And don't just, don't say that VBS did this. What did you do that made it so successful, you think? And what would you do differently?
Well, what we did is we listened to what VBS said to do. No, just so but we did. One of the things that really did make it very successful was the way in which it was rolled out, and listening to saying, this will work, and really believing in the process. I think that was really the most important thing, believing that it will work. The drip campaign that was offered was fabulous, and making sure that if people did have ask us questions, that we were able to redirect those questions, which is very important. We are not experts. Our our director of benefits here and myself, not an expert. We have the plan, but making sure that we were able to redirect those questions accordingly and making sure that we followed the path that was provided for us, like do this on this day, do this on that day, do this on this day. And I know at first I was very skeptical. I'm like, number one, we won't get 10 people to sign up. We got 47 people to sign up. And number two, I said, we will never get the 70%. And we kept saying the whole time, we're never going to get this. So you had to believe in the process. So we got over that. So that is a case in point. Like, I want my core benefits to be done this way because I would love something like this to happen. But it was just really believing in the process, sending out the information, and being able to address the questions that employees had for us the proper way. And it was honestly one of the most simple enrollments that we've ever had into a benefit. And all we had to do was just be a good partner. And the team is absolutely amazing. And it really is. And the benefit, of course, it speaks for itself.
Thank you. And I promise we won't boss you around and tell you what to do. But like, we'll provide the email on the day it's supposed to go out in the template that you already approved in a format that you can just hit forward all. So you're not going to have to remember to do it. We'll literally timeline every communication on the day. So you never have to wonder or remember, what is supposed to go out at this day. Will help you. And just to give you an idea what communications look like, everything has an actionable button on it. Click here to self-enroll, click here to schedule a call, click here to learn more. And just some samples here, like, again, think of it like modular learning, right? You guys are in education. So that's what we are also doing. We're educating, but again, doing it in a fashion where people can consume that information in small bite-sized pieces. These all animated videos are all under a minute long, and we do them in a certain sequence. So it builds up their base knowledge. So by the time they get to open enrollment, they're not deer in headlights. The first one would be like, what is long-term care? It'll talk about home health care versus facility. What does guaranteed issue mean? Being able to get coverage without medical questions. What percentage of people will need it? So on and so forth. You get the idea. By Gen Z and millennials. I'm going to stop talking and see if there's any questions from anybody out there for Natalie or for us.
I'm not seeing any in the chat.
Yeah, no. And while everybody's being so shy, I'll just follow up on something that Natalie spoke to. And Christina and Stevenson, thank you for staying with us to the end here. And I think what made it Point Park so great, and in other situations as well, Natalie and I talked about this afterwards, is it really was a true collaboration. Like, we have our process and our way that's going to be successful, but she was so involved in input. And Natalie, we talked about this, we tweaked things a little bit based on your suggestions to the culture there. And that's what made it really successful. And, that's what we'll do, Christina and Stephen, if we get the chance to speak with you all and get to that process, you're going to have your input too on what fits with your faculty and staff, and we're going to adjust and utilize that with our process, and that's what'll make it really engaging and successful.
Natalie, you've been wonderful. Do you have anything else that you want to add you've done an amazing job, but is there anything that we didn't cover you felt like you should share?
No, I think it's absolutely a great benefit. And being a person who's now going through this with Medicaid, and, having a home that now Medicaid's getting half of when the home sells because there wasn't a plan like this in place, I can say that this is definitely something everyone should consider. It's a great benefit for our employees. And even my own financial planner took it and said, oh, hey, by the way, I have this. Oh, you have one? Oh, whoa, awesome. Like, she was like, this is great. I said, yes, I know it's great. And now we get to add that to the portfolio. So that was what was really wonderful. And again, can't speak enough about how great the process was, and just believing it, working collaboratively. It was great.
Thank you again for your time. Shelley, thank you for organizing everything. We appreciate you as a fantastic partner. And thank you everybody else that attended today.
Thanks, Sean. Yep. And everybody who's still with us, I'll be sending you an email the next day or two, seeing if you'd like to schedule some time to talk about this one-on-one, or look at what a quote and the underwriting offer numbers would look like for your faculty and staff. So thank you. Thanks for your
Thanks,
time today.
Here's your survey, Shelley. I'm sorry.
Oh, yeah, thanks. No worries, Matt. This also gets included in the follow-up email, so we're all set there. All right, guys, thank you so much for your
Thanks,
time. You
everybody.
get 3 minutes back to your day. I hope it's a good one. I'll see y'all soon.